Tesla closed down 5.5% today, a sharp drop and a steeper fall than the wider market, caught up in a broad tech sell-off driven by two things: growing nerves about how much the AI giants are spending and a sliding SpaceX share price. We've also got a $5 billion Tesla energy deal in Europe, the first European regulator to speak warmly about full self-driving, Tesla pushing back hard on how a fatal crash was reported, and more. This is the Tesla Brief, after the close on June 23rd. Welcome to the show. A quick look at the stock. Tesla settled down 5.5% at $381.61. The Nasdaq fell about 2.2% on the day, and the S&P 500 dropped 1.4%. So this was a market story, far more than a Tesla story. But Tesla fell harder than both indexes, and the reason ties straight into today's lead. Let's start there. The session was rough for tech from the open. The Nasdaq dropped sharply after South Korea's Kospi index fell about 10% overnight, with chip stocks at the center of it. The semiconductor group was down nearly 7%, just a day after hitting record highs. Tesla traded down with that whole group, but the framing behind the sell-off is what matters, and it's worth slowing down on. CNBC reported today that the big technology companies are on track to spend around $750 billion building out AI infrastructure in 2026, up 80% from last year. And here's the part that spooked people. Analysis cited by CNBC from Goldman Sachs shows that the ratio of that spending to the cash these companies actually generate is now at its highest level since the dot-com bubble. In plain terms, these companies are spending money on AI far faster than their businesses are throwing it off. SpaceX, Google, Oracle, and Amazon have all turned to borrowing to fund the build-out. And Amazon and Oracle are both expected to spend more cash this year than they bring in. On top of that, a JP Morgan note flagged something telling. The biggest tech stocks have quietly become what they call a source of funds, meaning when big investors need cash, those are the stocks they sell first. So why does any of this hit Tesla, when Tesla's own AI spending looks nothing like a data center build-out? Because over the past year, the market has increasingly treated Tesla as an AI story. And when it does, it's willing to pay more for every dollar Tesla earns. That works both ways. When the market gets nervous about AI spending in general, Tesla gets sold along with the group, regardless of how its own books look. Today was the downside of that trade. And tangled into all of it is SpaceX. SpaceX priced its first ever bond sale today, raising $25 billion across 5 chunks of debt, with the longest not due until 2056. Demand was enormous. The order book reportedly approached $90 billion, nearly 4 times what was on offer. Most of the money refinances a loan from around the time of its IPO. But that strong debt sale landed in the middle of a brutal 3-day slide in SpaceX's stock. Since its IPO, roughly $600 billion has come off SpaceX's market value. The shares fell about 16% yesterday alone, to around $154, and Elon Musk's paper net worth has dropped by more than $300 billion. So you've got the bond market voting yes on SpaceX's creditworthiness, even as the stock market marks the equity down hard. Here's why a Tesla shareholder has to care about any of this. There's a thesis, pushed by the firm Jefferies, worth understanding. As Tesla and SpaceX get more entangled, from Musk's voting power, shared AI compute deals, and merger speculation, Tesla shares are starting to trade as a kind of SpaceX stand-in. And that runs in both directions. Today is what that looks like on a bad day for SpaceX. That speculation got sharper this week. Wedbush has put odds on an eventual SpaceX-Tesla combination, and Musk's voting control of Tesla just crossed 20%. None of that is a deal. I'll come back to that. But it's why a SpaceX slide now bleeds into Tesla. Gary Black, who runs the Future Fund and is a long-standing Tesla bull, weighed in on the SpaceX valuation directly today. His argument: SpaceX is wildly expensive for how fast it's growing. He pegs in at roughly 150 times a common measure of how pricey a company is against the cash its operations generate. For a business growing 35 to 40% a year. Nvidia, he notes, trades at about 19 times that same measure while growing 10 to 15%. His one-line verdict: the math doesn't math. Black has said SpaceX looked overpriced since before its IPO, so this isn't a new view from him. But on a sell-off day, it becomes the operative one. And it matters for Tesla holders for a specific reason. If there ever were a deal where Tesla owners swapped their shares for SpaceX shares, the price of SpaceX is what decides how good that trade is. Black's logic says SpaceX still has further to fall, which, if you believe it, means a Tesla holder should be in no hurry to swap into it. That same merger math has now produced a genuinely striking debate inside the Tesla investor community. A widely followed retail investor voice argued this week that Elon is deliberately slow-walking the robotaxi rollout to keep Tesla's stock price contained. Who runs Tesla's energy and charging business, leaned on exactly that vertically integrated pitch in Tesla's statement. Why this matters for the energy side of the Tesla story. It's a multi-year commitment in a region where Tesla's competitive footing has genuinely been questioned. And it deepens Tesla's role on the grid, from box maker to software and services provider, which is stickier and higher margin. What to watch, whether this shows up in Tesla's third and fourth quarter energy deployment numbers, and whether NatPower's 100 gigawatt-hour ambition turns into firm orders rather than a stated target. There was also a notable crack in the European story for full self-driving, and lately, that story has gone Tesla's way almost nowhere. In recent weeks, the Dutch regulator pushed back on FSD, Sweden urged the EU to reject it, and a Reuters report on Tesla's lobbying using disputed safety data put the company on the defensive. So the backdrop has been rough. Today, Finland's transport regulator, Traficom, broke that pattern. It said publicly it may approve Tesla's supervised full self-driving system before the European Union as a whole rules in October. And its language was unusually warm. In its words, the system has been observed to often make safer decisions than a human driver, and its response capability in many situations is faster than that of a human. The overall view of the system is positive. A single small country saying yes ahead of Brussels doesn't change the bloc-wide rules. But it gives Tesla a regulator officially on the positive side of the ledger, and it gives Brussels a bit of political cover to follow. And FSD in Europe is the single most watched gate for turning FSD into a real business outside North America and China. What to watch next, whether Finland actually issues approval before October, and whether any other Nordic regulator follows its lead. On the FSD safety front, there's a follow-on to a story we covered in yesterday's pre-market, the fatal crash in Katy, Texas, where a Model 3 struck a house and killed a 76-year-old woman inside. What advanced today isn't the crash itself, it's that Tesla is now openly fighting how it was reported. Ashok Ellaswamy, Tesla's head of AI software, posted vehicle data from the car. The driver pressed the accelerator to 100%, overriding full self-driving. The car reached 73 miles an hour on a residential street, and the driver was still on the pedal after impact. Elon backed him up, and the post has been read about 3 million times. Ellaswamy's argument was blunt. In his words, using Tesla self-driving is far safer than manual driving, and this was measured over 10 billion miles. Planting such FUD in the minds of general public, who might not know all the facts, might prevent them from using this technology that makes them safer. A couple of things to hold in balance here. The Federal Road Safety Regulator, NHTSA, has opened what's called a special crash investigation. That's a standard procedure for any serious crash involving driver assistance, not a finding of fault against Tesla. And the legal exposure is real. A fatal incident where FSD was engaged at any point in the sequence will get litigated regardless of the data. But on the narrow question of what actually happened in this crash, the vehicle data does appear to be on Tesla's side. The more notable shift is that Tesla is no longer letting that kind of story settle without pushing back hard. A few quicker items to round things out. Cars.com published its 2026 American-Made Index today, and the Tesla Model 3 took first place, with the Model Y second. That's the 6th year running a Tesla has topped the list. It scores cars on final assembly location, share of US and Canadian parts, and US manufacturing jobs. There's a real piece of news buried in it though. Last year, Tesla held the top 4 spots, but the Model S and Model X have dropped off because Tesla discontinued them earlier this year. The Cybertruck is excluded on a technicality. It weighs more than the index's 8,500-pound cutoff. Why it's worth a mention? With tariffs back in the conversation, a car's domestic content score reads directly through to how exposed it is to import duties. The vertical integration that Tesla's critics sometimes call inefficient is, on a tariff day, a hedge. And staying on the SpaceX AI thread for a moment, reports surfaced today of a SpaceX compute deal with Reflection AI, an open-source AI startup being pitched as America's answer to China's DeepSeek. It follows similar SpaceX compute arrangements with Anthropic, Google, and others. This one is a single, lightly sourced segment, so treat it loosely. But the pattern is the point. SpaceX's Colossus AI compute infrastructure, originally framed as serving Elon's own AI work, increasingly looks like it's being sold to outside customers as a real revenue line. That feeds the same all-under-one-roof logic: compute, models, robots, cars, driving this month's merger talk. That's the Tesla brief for today. If it's been useful, please subscribe. Thanks for joining us, and we'll see you in the next episode.